Hello friends, how are you? I hope you all are doing really good. So let's continue with our discussion on standard costing, and in standard costing we have been discussing about fixed overheads, right? So in the fixed overheads in the last lecture we discussed about the efficiency and the capacity variance. That volume variance is due to two reasons. One is the efficiency and another reason is the capacity. Capacity is that something you planned for, that a worker, according to us, the worker's capacity is working for 7 hours, he is actually working for 8 hours, right? So he is having more capacity than what we thought of, right? So that is capacity. Efficiency is that for a particular output that has been achieved, what is the standard hours for that output and what is the actual hours taken for that output, right? That shows the efficiency. Now, in this lecture, we are going to complete this standard costing. We are going to complete fixed overheads. Then quickly, I will brush up with the sales variances. Sales variances is very, very easy. Nothing much to discuss in that, right? I'll just give you the formulas, that how to make the formulas for the sales variances. Nothing much to be discussed, right? From the ICAI point of view, that is for the CA students, CA intermediate students, the sales variances are not there in the syllabus, right? So you can absolutely skip that. Okay, now coming to the next part. This is all we discussed in the last lecture. Now, in this lecture, we are going to talk about something, capacity variance. So we discussed that fixed overheads, capacity variance. Fixed overheads, capacity variance. Sir, what is this capacity variance? We say that actual hours minus budgeted hours multiplied by standard rate, right? What is this actual hours and budgeted hours signify? That budgeted hours is what we thought of, that the worker can work the number of hours. We say that a worker can work in a 1 month, say in a particular month, a worker can work for only 35 hours. But actually he is working for 40 hours. So we say his capacity is more than what we thought of. That's good, right? If he is working for extra 5 hours, if he has the capacity of working for extra 5 hours, that means he can do more production. That will be beneficial for us, right? That is why we say actual hours minus budgeted hours. The beneficial will be if the actual hours are more than the budgeted hours. Now, let's take a scenario. We are saying that he can work for 35 hours and this is for 25 days in a month. This is for 25 days in a month. But actually, he has spent 40 hours and he has worked for 27 days in a month. He has worked for 27 days instead of 25 days. Now, can we say that it is beneficial, that he has more capacity? Can we say that he has worked for more actual hours than the budgeted hours? Now, the comparison is not possible. Why the comparison is not possible? Because the budgeted hours are being set for 25 days, whereas the actual hours, these 40 are for 27 days. So this comparison is not possible. This comparison is not relevant. Clear? This comparison is not relevant. So what we have to do? To cover up this thing, we'll be studying two variances. Now this variance of 40 hours and 35 hours, this is variance due to the difference in the number of days. So we are going to study one variance known as fixed overhead calendar variance. Fixed overhead calendar variance. And this is the capacity that we judged, but it was misjudged due to the difference in the number of days. So we will have to revise our capacity. So for that, we will calculate fixed overheads, revised capacity variance. Right? So these are the two variances that we are going to study. That calendar variance, variance due to difference in the number of days that he is working, right? And because the capacity was misjudged or it was not judged correctly because of the difference in the days, we will calculate the fixed overhead revised capacity variance. Okay, so let's see what is fixed overhead calendar variance. First is fixed overheads calendar variance. Let's see. Fixed overheads calendar variance. Right? Fixed overhead calendar variance is what is the actual number of days that he is working. Right? Actual days. It's good if he is working for more number of days, it's good. It is not bad, but you have to be very precise with the variance, capacity variance. Actual days minus budgeted days multiplied by standard rate per day. Right? Standard rate per day here means the budgeted rate. How to calculate standard rate? Budgeted cost, total cost divided by budgeted days. Divided by budgeted days. This is how you will get standard rate per day. Right? Or there is another way of calculating this. There is another way of calculating is another formula for this. Another formula for this is possible hours. Another formula for this is possible hours minus budgeted hours multiplied by standard rate per hour. Standard rate per hour. What is possible hours now in this case? We say possible hours. What is possible hours? Possible hours is standard or the budgeted hours. Budgeted hours for actual days worked. For actual days worked. So it shows that for the actual number of days, that is for 27 days, what is my budgeted hours? And budgeted hours, not the actual hours. I say if we are calculating the budget, you want to see the difference, that what will be the variance due to this 27 and 25 days. So we say calculate the budgets for 27 days, calculate the budgets for 25 days. That will give you the variance. That will give you the variance due to the difference in the number of days being spent. So possible hours is budgeted hours for actual days worked minus the budgeted hours for budgeted days. Right? This budgeted hours, this one is for budgeted days only. Multiplied by standard rate. Clear? So in two ways we can do it. That is the fixed overhead, actual days minus budgeted days multiplied by standard rate per day. Or possible hours minus budgeted hours multiplied by standard rate per hour. This is how the calendar variance will be calculated. Now the last one. Finally, we are coming on to the last one. The last one is fixed overhead revised capacity variance. Fixed overhead revised capacity variance. Right? That means we are going to revise our capacity. Now, in this case, what we will do is how we are going to revise. We say actual hours minus actual hours is for actual number of days. Now the budgeted also we are going to calculate for the actual number of days. That for 27 days that he is actually working, what is the budgeted hours for those 27 days? Compare it with the actual hours of those 27 days. Only then you will get the correct capacity variance. Right? So actual hours minus possible hours. Possible hours multiplied by standard rate. Possible hours again, sir. Possible hours is budgeted hours for actual number of days worked. Now these actual hours, if we talk about these actual hours, these are for actual days. Right? That is 27. Again, possible hours is standard hours for actual number of days. Again, actual days. that is 27. Now you can compare and find out the actual capacity, that whether the worker has achieved more than his capacity or less than his capacity, because we have converted the budgeted hours for the actual number of days that he is working. Right? Now we can judge the correct capacity multiplied by standard rate. Simple. So these were the last variances, and in this case what we say is, in this case the fixed overhead capacity variance is equal to fixed overhead calendar variance plus fixed overhead revised capacity variance. Right? Fixed overhead capacity variance is equal to fixed overhead calendar variance plus fixed overhead revised capacity variance. Clear? This much is clear, I hope. So with this, we are done with the fixed overhead variances. So now we are going to do one example. We are going to solve one example. Let's write down the example first. Right? Let's write down the example first. Budgeted fixed overheads is equal to rupees 30,000. Right? Budgeted rate per hour is equal to rupees 1. Budgeted hours is 30,000. After that, budgeted production is 20,000 units. Standard hours per unit is equal to 1.5 hours. Now I'll talk about actuals. Actual output is equal to 22,000 units. After that, standard hours for actual output. This you will calculate. I'll not tell. We'll calculate this. Right? We will calculate this. Okay? One second, guys. I'm going to change this question. I'm going to change it. Wait. I'm going to change this question. I'll reframe this. Wait a minute. We'll reframe this. Write it again. Budgeted working days in a month. Budgeted working days in a month is equal to 25. Right? Budgeted production is equal to 20,000 units. Budgeted fixed overheads is equal to rupees 30,000. Budgeted fixed overhead rate per hour that is rupee 1. After that, actual working days is equal to 27. Then actual production is 22,000 units. Then we have actual fixed overheads. Actual fixed overheads is equal to rupees 31,000. And actual hours worked equal to 31,500 hours. Right? So this is the question that you people need to solve. The budgeted working days in a month are given. The budgeted production is given 20,000. Budgeted fixed overheads are given 30,000. Budgeted fixed overhead rate per hour is given, that is rupee 1. Actual number of working days are given 27. See, the capacity variance, when we talk about the calendar variance and the revised capacity variance, which we have discussed in this lecture, they can only be calculated if you have the budgeted working days and the actual working days. If these two figures are missing in the question, if the budgeted working days and the actual working days are not given, you cannot calculate this revised capacity and the calendar variance. You cannot calculate it. Right? So always remember, if in the question it is given that the budgeted working days and the actual working days, these are given in the question, then and then only you can calculate calendar and the revised capacity variance. Clear? Now, let's prepare the table for this. Let's prepare the table for this now. Right? So we have standard hours for actual output, standard rate, standard cost. Then we have actual hours, actual rate, and actual cost. Right? After that, we have the budgeted hours, budgeted rate, and budgeted cost. Now, let's see what is given in the question. In question, the budgeted cost is given to you. See, the budgeted overheads are given to you. That is 30,000. So, we can write it 30,000 here. Now, the budgeted hours are given. The budgeted hours are given or no? No, sir. The budgeted hours are not given in this question. But what is given is the budgeted fixed overhead rate per hour is rupee 1. Right? So the budgeted hour, this rate is given 1. So we can calculate the budgeted hours, 30,000. Any doubts? In this question, what is given to you? The budgeted cost is given 30,000 and the budgeted rate per hour is given 1. So we can calculate the budgeted hours, that is 30,000 from here. Right? Now, the actual hours are given. Sir, we are not using standard. We will come to the standards, right? So the actual hours are given, that is 31,500, and the actual cost is given, that is 31,000. Right? So the actual rate will be 0.98. Now, the standard rate is given 1. Coming to the standard hours now. Standard hours for actual output. What is your actual output? 22,000. Sir, but the standard hours per unit is not given. How to calculate the standards for the actual output of 22,000? This is the only point in this question. Listen to it very carefully. Calculation of standard hours for actual output of 22,000 units. Right? We need to calculate the standards for the actual output of 22,000 units. For this, listen to it very carefully. Sir, what is the standard hours for standard output? 30,000 is the standard hours for the standard output that is given 20,000 units. Right? This is the standard. So for 20,000 standard output, what is your standard hours? 30,000. This budgeted hours reflect the hours for standard output, right? What is your standard output in this case? 20,000 units. So that is what I have written, that for 20,000 standard output, my budgeted hours or the standard hours are 30,000. So I need to calculate for actual output. So for 22,000 actual output, what will be my standard hours? 30,000 divided by 20,000 multiplied by 22,000. Right? So this will come to 33,000 hours. Right, so this calculation is important in this question. This calculation is important. So here we will write 33,000 multiplied by 1, standard cost will be 33,000, right? So with this, your table is complete. Now you can calculate all the variances. That will be pretty easy. You can easily calculate all the variances now, right? In this case, when we are going to talk about the revised capacity variance, there we are going to use the term possible hours. Possible hours. What will be the possible hours? These standard budgeted hours of 30,000 are for how many days? For 25 days. We need to calculate for 27 days. So the possible hour says that for 25 days, my budgeted hours are 30,000. So what will be the budgeted hours for actual, that is 27 days? That will be 30,000 divided by 25 multiplied by 27. Right? That will be 32,400. 32,400 hours. This will be your possible hours. Now, this is your homework. I have prepared the table for this. You people have to solve this question now, right? You people have to calculate the variances. I'll give you the answers, that what will be your answers, right? I don't think so that there will be any issues in that. I'll give you the answers, don't worry. So the fixed overhead, the first is fixed overhead cost variance. Fixed overhead cost variance will be 2,000 favorable, right? Second will be fixed overhead expenditure variance. That will be 1,000 adverse. Then we will have fixed overhead volume variance, right? That will be 3,000 favorable. After that, the fourth one will be efficiency variance, fixed overhead efficiency variance. That will be 1,500 favorable. Then we will have fixed overheads capacity variance. That will again be 1,500 favorable, right? Then sixth, fixed overhead calendar variance. Fixed overhead calendar variance will be 2,400 favorable. Then fixed overhead revised capacity variance, that will be 900 adverse. So these will be the answers, right? Now you people have to solve it and tell me in the comment section that whether you have been able to do it or not, right? Please let me know in the comment section that whether you have been able to get all the answers correctly or not. The major part I have done, right? The major part, that is the calculation of the standard hours for actual output plus this making of the whole table, that is done for you people. You only have to put it into the formulas. I've calculated the possible hours also for you, right? So you just have to put the figures into the formulas and calculate it. I have given you the answers, that these will be the answers. Please let me know in the comment section that whether you have been able to do it or not. In case you are not able to do it, we will solve it. Don't worry about it, right? Or in case you have any queries, you can mail me at ksjteaching@gmail.com. Okay, so guys, do not forget to subscribe to the channel. Do not watch without subscribing to the channel, right? And press the bell icon so that you get all the notifications in time. Share with maximum people, all your friends, right? Spread it like a wildfire. Only then it is beneficial of putting so many lectures, so many hours, so many efforts, right, into all these things. The beneficial is only then. Right. So we are almost done with this. If you are a CA student, you can leave the lecture here, right? Because the sales variances are not for you people. Sales variances are not for you people, because we are quickly going to go through with the sales variances. Very easy variances, right? Nothing much to be discussed about. The sales variances, I can say no complications, nothing as such. right? Nothing as such to be done. So quickly I will show you the table how to prepare the sales variances. So we will talk about the sales variances. Sales variances or the sales margin variances are also there. That is, there we consider instead of sales margin means the profit, right? We consider the profit. So instead of the sales, you will write sales margin. That's it. So we'll discuss only the sales variances. Nothing much to be discussed in this, right? Simple table, sir. Say there are 3 products that you are going to sell, that is A, B and C, right? So what is the standard quantity that you have planned for? So you will write standard quantity, that is the planned quantity, no actual output or nothing, just the standard quantity what you plan to sell, right? Then what is the standard price, standard sales price that you want to sell at? Then that will be the total sales value, standard sales value or the budgeted sales value we call it as, right? What is the actual quantity that you have sold? What is the actual price that at which you have sold? What is the actual sales value that you have achieved, right? And in this case also, actual quantity, actual sales price and actual sales value. In this case also you can calculate the revised sale quantity on the same logic, right? On the same logic, if you have multiple products, you can calculate the revised quantity on the same logic, right? So there is no fundamental of actual output or anything, no problem, simple. What is the standard quantity that you plan to sell? In which ratio you plan to sell? That you will sell 100 units of A, 200 of B and 300 of C. What is the selling price, standard selling price, and what is the sales value? Now actual quantity, in which ratio you have sold? You might have sold 150 of A, 150 of B, 100 of C, right? So in which proportion, depending upon the demand, you have sold your product at what actual price that you have sold. Revised standard quantity is that say you have sold actually sold in the wrong proportion. Depending upon the demand in the market, you are selling the product. Say the demand says that 100 units of A, 200 of B and 300 of C should be sold. Whereas actually you have sold 150 units of A, 100 units of B, right? 250 and 600, okay, then 350 units of C, right? This is what you are actually selling. So what you will do? You will revise this actual quantity in this ratio 100, 200, 300, that is 1:2:3. Clear? So this is about the sales variances. Let's quickly discuss what all variances do we have. The first one is the sales value variance. The first one is sales value variance, right? The sales value variance is very simple. It is the actual sales value minus the budgeted sales value. Budgeted or the standard sales value, one and the same thing. Budgeted sales value. In this case, it will always be beneficial if your actual sales are more than the budgeted sales. You will get more income, right? So we will keep the actual figures first and then the budgeted or the standard figures, right? Because it is always beneficial if the actuals are more than the standards. This is the first one, that is the sales value variance. Second is sales price variance. Okay, so what about the sales price variance? It is beneficial if actual price is more than the standard price. So actual sales price minus the standard sales price multiplied by actual quantity that you have sold, right? Third one, sales volume variance. That is quantity variance. Volume means the quantity here, right? So this is actual quantity minus standard quantity multiplied by standard selling price. The same fundamental remains the same. The only thing is, in the sales variances, we'll take the actuals first, right? Because the actuals, it is better to have actuals more than the standards. After that, sales mix variance. Sales mix variance is actual quantity minus revised standard quantity multiplied by standard sales price. Right? Then we have the sales yield variance. Sales yield variance. Right? Sales yield variance is revised standard quantity minus the standard quantity multiplied by standard selling price. Right? This is all about the sales variances. The same fundamentals are same fundamental. The only thing is that it becomes easy because you don't have to calculate the standard quantity for actual output. There is no fundamental as such that you need to calculate the standard quantity for actual output. Nothing of that sort. Right? Nothing of that sort. Clear? So with this, we end this chapter of standard costing. There is nothing else to be covered in standard costing. I've tried my best to explain all the concepts in the simplest of the ways I can. Right? So there is one question on the sales variance, question number 7. Right? Question number 7 is there. So you can solve this question number 7, right? So you can solve this question number 7 on your own. Very simple question, very simple, right? Please solve it on your own. In case you have any issues, you can let me know, right? So next lecture, we are going to start with our new chapter, that is marginal costing, right? We are going to start with marginal costing. So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.